For millions of Americans, the problem with their paycheck isn't necessarily that they're earning less, it's that their income isn't rising fast enough to keep up with the cost of living. The latest U.S. labor market data reveal a troubling combination. Wage growth has slowed, hiring has weakened, and consumers are becoming less confident about the job market. Average hourly earnings increased just 3.2% over the year in July. That's a problem when inflation was running at 3.4%, according to the data cited in the source report. In simple terms, workers were seeing their paychecks grow, but prices were still rising faster. And that creates a bigger question for the entire U.S. economy. If Americans have less purchasing power, how much longer can consumer spending keep supporting economic growth? At the same time, weaker wage growth could actually make one very important institution more comfortable: the Federal Reserve. Because slower wages can reduce the risk that inflation becomes self-reinforcing, and that creates a fascinating economic trade-off. Let's break it down. The July jobs report delivered a much weaker picture of the labor market than many expected. The economy lost 23,000 jobs in July, while the unemployment rate edged down to 4.1%. But that decline in unemployment was partly explained by people leaving the labor force, rather than by a surge in hiring. Meanwhile, wage growth slowed to 3.2% annually, so the headline unemployment rate doesn't tell the whole story. Underneath it, the labor market is becoming less dynamic, and that matters because the strength of the labor market affects much more than employment. It affects wages, consumer spending, inflation, interest rates, and ultimately, the performance of businesses and financial markets. The paycheck problem. Think about what happens when your paycheck rises by 3.2%, but the prices of goods and services rise faster. Your nominal income is higher, but your purchasing power can still fall. That's the key distinction. A worker might receive a raise and still feel financially worse off because groceries, housing, transportation, insurance, and other expenses consume more of that paycheck. And when that happens across millions of households, the consequences can spread through the economy. Consumers may delay major purchases, they may reduce discretionary spending, they may rely more heavily on credit, or they may simply save less. That creates pressure on businesses because consumer spending is one of the major engines of economic activity. So weak wage growth isn't just a labor market story, it's also a consumer story. Why aren't employers raising pay faster? Normally, a shortage of workers should give employees more bargaining power. Fewer available workers can mean companies compete more aggressively for talent. That competition can push wages higher. But that's not what we're seeing right now. The labor supply has been constrained by factors including baby boomer retirements and tighter immigration policies. At the same time, demand for workers has weakened, and that's the important part. There may be fewer workers available, but companies are also less aggressive about hiring them, so workers aren't necessarily receiving the kind of wage increases that a traditional labor shortage might produce. The result is a labor market where employers appear to have more leverage. And that leads directly into the next question. What does weaker wage pressure mean for inflation and the Federal Reserve? The wage price spiral question. For decades, economists have debated the relationship between wages and inflation. One concern is the so-called wage price spiral. Here's the basic idea. Companies face higher labor costs. To protect their profit margins, they raise prices. Consumers then face higher prices and demand higher wages. Employers raise wages again. Those higher wages increase costs even further, and the cycle continues. That dynamic became especially damaging during the high inflation period of the 1970s. But today's labor market looks very different. Hiring has cooled, wage growth has moderated, and employers aren't competing as aggressively for workers. That makes it harder for inflation to feed continuously into higher wages. Why the Fed is watching closely. For the Federal Reserve, this creates a complicated situation. The central bank wants inflation to move toward its target, but it also has to consider employment and economic growth. If wages are rising rapidly while companies are struggling to find workers, policymakers may worry that inflation could become persistent. But if wages are growing slowly and hiring is weak, the risk of a wage-driven inflation spiral becomes smaller. That could give the Fed more flexibility. In other words, weak wage growth is bad news for workers. But from an inflation perspective, it can be somewhat reassuring. And that's where the economic story becomes much more complicated. A labor market that's low hire, low fire. One of the clearest descriptions of the current environment is a low hire, low fire labor market. Companies aren't necessarily rushing to hire, but they also aren't broadly laying off workers. Instead, many businesses appear to be waiting for more clarity, waiting to see where the economy is heading, and increasingly, waiting to understand how artificial intelligence could change their industries. That uncertainty can weaken wage competition. When companies aren't competing aggressively for new employees, workers have fewer opportunities to negotiate higher salaries. And consumers notice that uncertainty. A Conference Board survey found that only 24.6% of consumers said jobs were plentiful in July, down from 25.5% in June. That may seem like a small change, but it illustrates a broader shift in how Americans perceive the labor market. The job market may still look relatively stable by traditional measures, but it doesn't necessarily feel strong. The consumer spending risk. This matters because the U.S. economy depends heavily on consumers. When households feel confident about their jobs and income, they're generally more willing to spend. They buy cars, they renovate homes, they travel, they eat out, they purchase electronics and other discretionary goods. But when wage growth slows and job security becomes less certain, households can become more cautious. And that's where weak wages can become a broader economic problem. The concern isn't simply that Americans earn slightly less than they expected. The concern is that slower income growth can reduce the ability of consumers to absorb higher prices. That can eventually affect corporate revenue. And if businesses experience weaker demand, they may become even more cautious about hiring. That creates a feedback loop in the opposite direction. Slower hiring can weaken wage growth. But AI is creating a different wage story. There is an important exception to the broader wage slowdown. Some industries connected to the artificial intelligence boom are seeing stronger wage growth. Research cited in the source article points specifically to construction, information services, and utilities. Why those industries? Because they are closely connected to the massive infrastructure investment required to build and operate energy-intensive data centers. Think about the physical side of AI. It isn't just software. It requires buildings, electricity, cooling systems, networks, specialized infrastructure, and large amounts of capital. That investment is creating demand for workers in certain parts of the economy. So, while overall wage growth is subdued, some AI-related industries are experiencing stronger compensation growth, and that creates a fascinating split in the labor market. AI may be reducing demand for certain types of work while simultaneously increasing demand for other skills and infrastructure. The productivity question. This brings us to perhaps the biggest unanswered question surrounding the AI boom. Will artificial intelligence eventually make the economy significantly more productive? There are reasons for optimism. Companies have been investing in technology and intellectual property for years, including before the current AI boom. Those investments have helped businesses produce more with their existing workforce. But there is a major timing problem. The inflationary effects of AI infrastructure investment can arrive relatively quickly. The productivity benefits may take much longer. Building data centers requires construction, energy, equipment, and other resources today. But the productivity gains from AI may take years to spread across the wider economy. And policymakers have to deal with the economy they have today, not only the one they expect to see tomorrow. That is one of the central challenges facing the Federal Reserve. The Fed's difficult balancing act. The Federal Reserve is effectively looking at two different economic stories. On one side, inflation remains a concern. Energy shocks and heavy investment in AI infrastructure can put upward pressure on prices. Some Fed officials therefore remain concerned that inflation could require tighter monetary policy. On the other side, the labor market is cooling. Hiring has weakened, wage growth has slowed, and consumers are becoming less confident about employment conditions. Those developments could argue for patience rather than additional rate increases. That's why weak wage growth is such an important signal. For American workers, slower wages mean less purchasing power. For the Fed, however, slower wages can mean less risk of a wage price spiral. And for investors, the implications are even broader. If weaker labor market conditions convince policymakers to keep interest rates lower than previously expected, borrowing costs could eventually become less restrictive. That can influence everything from corporate financing to consumer credit and valuations across financial markets. But investors also have to remember the other side of the equation. If inflation remains elevated because of supply shocks or infrastructure spending, weak wage growth alone may not be enough to guarantee easier monetary policy. The Fed has to balance both risks. The latest wage data tell a story that is easy to miss if you focus only on the unemployment rate. The U.S. labor market isn't collapsing, but it is clearly losing momentum. Wage growth of 3.2% is modest compared with the inflation rate cited in the source report. That means many workers are struggling to increase their real purchasing power. At the same time, Weaker wage pressure reduces the possibility of a self-reinforcing wage price spiral. So the same economic development can be negative for households while potentially reducing pressure on the Federal Reserve. And then there's AI. The technology boom is already generating stronger wage growth in some industries tied to infrastructure and data center construction. But the bigger productivity gains economists are watching for have yet to become obvious across the entire economy. That leaves the United States at an important crossroads. Consumers need stronger real income growth. Businesses need clarity about demand. The Fed needs inflation to cool without unnecessarily damaging employment. And investors are watching all three. The next phase of the U.S. economy may depend on which force becomes dominant: weaker labor demand, persistent inflation, or an eventual productivity boost from AI. Thanks for watching. We'll continue following the latest developments in wages, inflation, the Federal Reserve, and the U.S. economy. See you in the next video.